Welcome to the FinTech One-on-One podcast. This is Peter Renton, co-founder of FinTech Nexus and now the CEO of the FinTech consulting company Renton & Co. I've been doing this show since 2013, which makes this the longest running one-on-one interview show in all of FinTech. Thank you so much for joining me on this journey. Now let's get on with the show. Today on the show, I'm delighted to welcome Christian Widhalm. He is the CEO of Bloom Credit. Now, Bloom Credit, super interesting company. They are in the credit data infrastructure space. And if you don't know what that means, you will certainly by the end of this interview. They interface between the credit bureau and the lender, and they make credit bureau data more easily consumable to the lender and vice versa. The furnishing of credit data back to the credit bureau, they make it that much easier as well. And they've got a new product, which we go into in some depth, called Bloom Plus, which really dives into a bank account's history, the last 2 years of information, and it looks for trade lines, which we talk about how it works, don't worry. It is a game changer, I think, for a lot of banks, credit unions, fintechs, where you can kind of help your customers build their credit without actually having to go into debt. Super interesting discussion around that. Anyway, it was a fascinating discussion. Hope you enjoy the show. Welcome to the podcast, Christian.
Thank you for having me, Peter.
My pleasure. Let's start by giving listeners some background. I first met you when you were at LendKey. I know you spent quite a few years there. But why don't you just go back into your career, hit some of the highlights that you've done to date?
Yeah, so I've been in fintech for 15 years. Before that, ironically, I worked in the business side of sports for a few years out of college, and somehow stumbled into fintech, not knowing anything about it, not really fully understanding credit and all the different players that were in the market. So it was a fascinating time for me to join. That was back in early 2010, and that was at LendKey. And I was at LendKey for 11 years. When I left there, I was a chief revenue officer. And what LendKey does is provides credit unions and banks with the ability to acquire new loans, new assets in a digital platform, really targeting mostly younger demographics for the most part, a lot of student lending and student loan refinance. A little bit different than some of the other fintechs that were out there in terms of the fact that we were partnering with banks and credit unions in order to originate and then service those loans, as well as provide some capital market services to them. Mm-hmm. So over my time there, I think we worked with 350 to 400 banks and credit unions. And the CEO over there, Vince Passione, has definitely been a mentor to me over the course of my career and kind of threw me into everything over time. If there was something to be fixed or some problem, it was kind of like throw Christian at it. And ultimately that led to me probably in my last 6 years or 7 years, building out all the client-facing functions and sales organization, as well as business development and marketing. A lot of interesting stuff over the time there. Really loved my experience. And honestly, I think that the one thing that Vince really helped me prepare for was really what it takes to serve the needs as a partner for regulated financial institutions, right? Taking that with me and ultimately come to Bloom Credit and looking to do the same with working with banks and credit unions here.
Okay, so you knew Matt Harris, the founder of Bloom Credit, right? Not the Matt Harris Bain Capital, the other Matt Harris, just to be clear. So tell us a little bit about your relationship there and how you how Bloom Credit first got on your radar.
Yeah, so Matt was a colleague of mine at LendKey. He used to always look at these problems about people that we'd say no to, right, in terms of credit. His thought was, how do we actually make that experience better to try to get people back into the funnel and get them later when they become credit eligible? And ultimately, he decided to leave LendKey and start Bloom Credit. He asked me to co-found it with him. And at the time, the idea that he had was an interesting idea, but it was more consumer-facing. And my background's B2B. I'm more kind of a B2B guy in general. So I passed on co-founding it with him. This was probably late 2016. But I wanted to help him because I really like Matt. He's super smart. And I thought that this was an interesting idea for him to pursue. So I helped him with the initial models. I helped him with some early kind of pre-seed pitch stuff. I coincidentally named it Bloom Credit. And then I just acted as an advisor. and would, work with him when he needed any help or needed advice on anything. Ultimately, after a few years of pursuing the consumer model, Matt was just seeing friction in the process of working with credit data that really led him to start to pivot the business, I think in 2020, towards B2B. And shortly after, I think January of 21 or so is when I got a call to see if I was interested in coming in to be CEO of Bloom Credit. I think that Matt had been in it for a bit, wanted a bit of a break, and it was a really interesting opportunity for me, specifically because I loved the pivot. Being in B2B fintech for 11 years before that, I had seen the friction with credit data and the way that it was kind of being used and transmitted within the ecosystem, and especially the timing, right? We've been at this like interesting convergence probably since like Plaid and everyone really started really accelerating probably 8-9 years ago, where this convergence of traditional credit data, so stuff at the bureaus that's payment information on consumers for loans and credit cards, but then also this whole thing of like alternative data and cash flow, right? And looking at cash. And the issue is really that the rails for credit data were never really designed for this convergence of all this data being in the system. Metro 2, which is the format at which contributors of repayment data, so lenders, send their information to the bureaus. And that's 26 years old and didn't really accommodate, I would say doesn't really accommodate a lot of the new alternative data that ultimately could go into the bureaus, and also new types of payment products, as well as just lending products, so like BNPL, buy now, pay later, for example.
Mhm.
Then there's been a struggle to get BNPL reported. And part of it is because the bureaus and the scoring models were never really designed to take in BNPL data, which was, paying 4, paying 6, intra-month payments, not understanding kind of potentially what was going to happen to credit scores of this type of behavior with consumers using those products. And looked at this as a real interesting opportunity to help redefine the infrastructure on how credit data gets from point A, the lenders who have it, both traditional as well as alternative data that kind of sits within their own systems, and get that over to the major credit bureaus where we can put it into formats that meet the business needs and use cases for the bureaus, because there is quite a chasm there between the data on one side and the way that the bureaus need to take it in. And the bureaus are ultimately the best path for dissemination of that type of credit data back to lenders to use it in the market. And with the idea that the more data that's available on consumers, the more that you can actually expand access to affordable credit.
Right. So let's dig into that for a little bit, because I want to talk about the credit data that, I mean, you said it has to be in this Metro 2 format, right? So are you able to stuff more data into that format, or like how is it actually working in practice?
Yeah, so the format, like, so Metro 2 as a format does have various types of data fields that ultimately can be transmitted. The problem is the formatting in which you get it from the contributor, the lenders, over to the bureaus. So, like, for example, and we've talked about this, but we've launched a new product off the platform that we have called Bloom Plus, which allows for FIs to connect their depositors' checking accounts so that we can actually see what's in their checking account and then convert those types of transactions, call it rent, telco, utilities, into trade lines that go to the major credit bureaus. So the Metro 2 format says, yeah, we added this thing called rent, we added this thing called utilities and telco, but typically the way that data would actually go from a rent for rent, telco, or utility payments before the type of solution that we are offering is by the landlord or the property management company directly sending data to the bureaus, right? And there's not that many of them that ultimately do. It's definitely not the majority of rent is reported in the US today. And the same thing with utilities. It would come from the utility provider or from the telco provider. And a lot of those folks typically don't report credit data unless there's an issue, right? Someone goes delinquent and they need to use it as a stick for collection purposes. But there's all sorts of data that resides within checking accounts that, if converted appropriately to meet the needs of like the bureaus via Metro 2 and a delivery mechanism, it can be very valuable data, not only for the consumers who can build credit history, but also for lenders who actually now have more access to data to make more informed lending decisions.
Right, right. So I do want to dig into Bloom Plus in a little bit, but I want to go back to when you started the B2B pivot. you talked about being this like intermediary between the lender and the bureau. Tell us sort of how that solution works exactly.
So Bloom is B2B credit data infrastructure. We're an API platform that has bidirectional APIs to the major credit bureaus and our clients. So what does that mean? It means that clients can actually go and pull data through our platform for all three major credit bureaus. We standardize it so that it comes back to our customer the same format, so they don't have to actually maintain translations and all these integrations with the bureaus themselves. And it makes it way easier for them to actually work with the data. And then on the return side, the other direction is furnishment, which is industry jargon for credit reporting. And that's actually helping clients send data from their systems of record, whether it's a loan management system or in the case of Bloom Plus, a checking account, into the bureaus, right? And the way that that works, again, single API, our clients connect into our API with their system of record data. We take their raw data from their system of record, we transform it into formats that are going to be acceptable by the bureaus, but we also run, I think we're now over 700 data quality and validation checks that we actually run on the data to make sure it's as accurate as possible. But in addition to that, we designed the platform from the beginning to really address the modern needs that are actually happening with credit data. And specifically for furnishment or credit reporting, there's a few of them. One is you want the data to be as accurate as possible, right? And that's why we run all those quality checks and whatnot. If you look at the CFPB, they put out a lot of announcements about their struggle with how much illogical data there is in the bureaus. Things like, hey, you're showing that you're 60 days delinquent, but the account was open 2 weeks ago. Like, how is that possible, right? And there's a lot of that type of data that just ultimately goes into the system. So accuracy is big. And one of the reasons that for that is because you have an interesting sort of impedance mismatch of all of these systems that 10,000 banks, credit unions, and others use on one side. It can be cores, the LOSs, then it flows into loan management systems. And not all of them are really looking at like, how do we actually report credit data the absolute best, right? They're saying, how do we make the best loan origination system, or how do we make a great loan management system?
Right.
But with all these different formats and everything, it leads to errors and things coming through. So one thing that we wanted to make sure is that those errors weren't happening. The next one is different types of data. So instead of making it all about like Metro 2 and traditional credit data, we made our system more agnostic so that we can we can take in alternative data and then transform it and then flow it back to the bureaus to maximize how much data the bureaus have on consumers to get out into the market to help lenders make better decisions and expand access to affordable credit. The other part is speed. So the traditional like credit reports and whatnot, like they really go off a 30-day statement cycle, right? So data that's actually inside the bureaus probably can be 45 days stale or so.
Mm.
And so we built our system in a way that can be near real time. So as soon as something is actually updated in a system of record, within minutes, we can have that in our system, transform it and actually send it to the bureaus. That can be new accounts being opened. It could also be payments being made, statuses of accounts. And we think that real time is going to be critical in the future because everything else is kind of real time. I remember when it was a big deal to have real time credit decisions, right?
Right.
We're still on 30-day lags on reporting of credit data. And I think in the future, the more accurate, the faster it's there, is going to be better for everybody, for the bureaus, for lenders, as well as for the consumers. So that's effectively what we do bidirectionally and made it very modern in order to account for today's needs, which are growing every day.
So you're providing the data back to the bureaus in real time or close real time, it sounds like. When you're pulling a credit record for your lenders, it's not going to have that real-time data in it, is it? Or is it just for those companies that actually are working with Bloom Credit, then do you get the real-time data back from the bureaus?
The interesting thing with the real-time side is that we built it to accommodate it because we know that's where things are going to go. And there's certain repositories that can take stuff in real time. The bureaus today don't take real-time kind of payments coming through or statuses because they're kind of built more on a monthly cadence.
Right.
And it's not that they can't do it, but it's also like, how do they display it? And I think that and I'm talking with the bureaus, they all want to get there, and they're trying to figure it out. But in reality, I think it's a little bit of a timeline for them to do it because they need to really kind of format it in a way that's going to be easy for lenders to actually take that data in and understand it. But there's other repositories and folks that are working on stuff that actually do want data in real time. So we built it to accommodate both, and we think that the bureaus will get there over time, and I think they have to get there over time because this is just going to be the direction that everything is going. If you're making decisions off 30-day-old data, why if you don't have to?
Yeah, I mean, the reality is it should have already happened, in my opinion.
I completely agree.
They should have started this project 10 years ago, and it should have been implemented 5 years ago. But anyway, I'm not going to bash the bureaus. I know they've got a challenging job. But so then you're working with lenders both bidirectionally. So they're basically working with Bloom Credit to pull credit data to the format that they like, and then they're furnishing it back. You're not storing any data, right? It's just flowing through you to go to the credit bureaus. So, because what I'm wondering is you would have the situation where you're working with a bunch of lenders, someone's going to be pulling a record from the bureaus with data that you have provided real-time updates to like 2 days ago. You're not really intercepting that and enhancing the credit bureau record, even though you know that this person was actually, was updated 2 days ago.
So we do store, because one of the things that we do as part of this is that we manage 24 months of payment history for all the files, right? So we do store and have the information. It just depends on when it goes ultimately to the bureaus. But that's also one of the things too. I mean, keeping 24 months of payment history and or if not more, gives us the ability to also make sure that from an accuracy perspective that consumers aren't getting hurt, right? Because that's also natural sequencing. If I know that the last 3 months, all the data that we've taken in and we've converted and reported showed a consumer being current, and now this next month they're showing up as 120 days delinquent from our lending partner, we know that there's a problem, and we flag it. We ask our clients to remediate it, and oftentimes our clients are finding systemic issues that are within their own systems that they need to fix. And I think that's been a very valuable thing for clients indirectly, right? Is the audit that we actually perform to actually help them improve their own systems. And the reality is there's a lot of errors on credit reports that have just been out there. I think that the number is like 34% of consumers in the United States say that they identify at least one error on their credit report. So we think there should be a world where that shouldn't be the case, right? It should be
1%.
Yeah, it should be the highest levels of accuracy. And there shouldn't be anything that is actually negatively impacting, like errors that are really grossly negatively impacting the consumer and their ability to get credit, or at least access to affordable credit. And so as part of all of that, right, like we really take a hard look at, like I said, quality and accuracy. And so that's one of the reasons that we store all this data.
Gotcha. Okay. I presume you're working with some fintech lenders, but are you also working with banks and credit unions? I mean, who is using Bloom Credit today?
Yeah, so we started with like kind of two categories of customers. One I would call is like a direct customer. So that's someone who is taking our infrastructure because they don't want to integrate with the bureaus. They don't want to maintain everything, and they want to use really good, best-in-class, off-the-shelf software that they can enable their product team with. And so that's somebody like a net spend, right, is one of our clients, right? Large prepaid card issuer in the United States. They use us. They have their own direct consumers that they work with. Then there's platforms. So there's like Marqeta, Imprint, Loan Pro, those types of companies that ultimately want to provide their customers with the ability to have really good credit solutions that they can offer to their end customer. Right. And so they integrate Bloom in order to facilitate that. So again, they don't have to actually go and maintain anything. All the rails run through Bloom on the credit data side.
Gotcha.
So those are on the fintechs. On the banks and the credit unions, we're just actually now getting into banks and credit unions, and that's more with the Bloom Plus product, going upstream into them.
When you describe Bloom Plus, I think of Experian Boost. One, how is Bloom Plus different, or is it different to Experian? I mean, I presume obviously you're agnostic with credit bureaus, right?
Yeah, we're agnostic with credit bureaus. We look, credit bureaus are our partners. We work very well with them, and we think they're obviously a very critical piece of the underlying financial ecosystem within the United States. But for what we built with Bloom Plus is similar to Experian Boost in terms of what the outcome is for the consumer, but we built it differently, right? So we built Bloom Plus in a way that is completely B2B and allows any FI in the country the ability to offer the experience white labeled to their deposit base. so they can keep sovereignty over their deposit customer, right? Without them going elsewhere to seek this type of a solution where they might be cross-sold other products and services, or are paying a hefty monthly fee between $3 and $15 a month for some services to report certain types of things, and really maintain the relationship with their customer. And the reality is that, and I always am blown away by this number, but there's 100 million, over 100 million people in the United States that don't have access to mainstream credit products or rates. About 50 million of those are subprime, so they've done something to impair their credit. But the other 50 million are thin file, no file, limited credit history, unscorable, that could be 18 to 24-year-olds early on in their borrowing, credit years. It could be immigrants with limited access to credit in the United States and subsequently have limited history in the United States. So it's a real large population. You're talking like 40% of the eligible credit population, I think over 18 in the United States is around what the number is. And in order to solve that problem, the question is, how do you actually allow people to build credit without taking out debt?
Right.
That's always been the chicken or the egg, right? Like, how do you actually do this? And so we've collaborated with one of the major credit bureaus, TransUnion, when we first launched our product. And the focus of it is there's tons of data that exists within checking accounts. Right. And if formatted correctly, treated correctly, and made sure that it's done in a right way that's actually very clear to the consumer can permission their data from their checking accounts to be converted into trade lines with the major credit bureaus. And that's exactly what we do. We basically show the consumers within their checking account all of their recurring monthly obligations that potentially will be accepted by the bureaus as trade lines. And then we get them to attest to them. Here they are. Here's your rent. Here's your telco. Here's your 3 utilities. Click the button, attest to it. And then within 24 hours, we will report that to the bureaus. The very interesting thing about this is the impact that it can have quickly to a consumer's credit profile.
Right.
Reason being is because we're pulling 24 months of account history out of the checking account, so that if a consumer enables their rent to go through and their telco, let's say, and they've been paying those out of their checking account for 2 years, within 24 hours, we will have sent that over to the bureaus. They will have ingested it, and then they will magically have 2 new trade lines with 24 months of history. So if you think about that compared to, traditional sort of credit builder products that you have to take out, and then over time you're building credit, you have the ability to make an immediate impact to your credit history as a consumer as soon as you enable these transactions out of your accounts to be submitted to the bureaus and converted to trade lines.
So I imagine not everything is converted to a trade line, right? Because you go through to a checking account, you could possibly see, you might have Netflix, you might have ESPN Plus or whatever. So what are the actual trade lines? Like if you're going to open a trade line at a bureau, I imagine they're not really interested in Spotify, are they?
So Experian, I think, does accept those today. They accept like Spotify, Hulu, Netflix, stuff like that. That's definitely not traditional. And I think that over time that there could be interesting stuff to show indicators of credit risk out of them. I think that right now it's probably early for those types of things. So the key ones that are reportable that are going to have immediate impact credit history and credit score are rent, telco. And telco can be either your own cell phone bill, or it can be your Comcast Xfinity bill for your home, things along those lines. And then your utilities, water, gas, and electric. So those are the 5 today that we are really looking for, and then ultimately convert for the consumers into trade lines with the bureaus.
Right. Because this brings me to the question that actually really was the genesis of this interview when I posted on LinkedIn. I've got a son who's about to turn 18. He's going to start his financial journey. He's a senior in high school right now, so he doesn't really have much in the way of regular expenses. But when I've been thinking about this, and I got some really good feedback on when I posted this on LinkedIn, and you were one of the people that shared feedback, that there really hasn't been to this point. Okay, you turn 18. Here's how you enter into the credit system. Here is the on-ramp that most people take, that is the best practice to take, kind of thing. It's like, some people are doing credit builders. Some people try and get their own, secured credit card or whatever. But I'd love to, because what you're saying is this is about as good an idea as I've seen. Or the average 18-year-old is not going to have a utility bill or or it might have a cell phone bill. But right now, like, what do you say to that question? How can new immigrants, new adults enter the credit system most successfully?
Yeah, and I think it's always tricky because I also look at myself back when I was probably, 18, 19 years old, and I remember being on college campus and getting solicited credit cards. I'm like, "Oh, you're going to give me a credit card? I'm going to
Yeah, they
call."
don't do that anymore.
Yeah, I know. Thank God for the Card Act. But
Yes.
all of a sudden, like you're getting stuff that you don't even know how to pay for it or like what you can afford, and So I think that especially for younger demographics, and it's just me personally, it's like I think one of the best things to do is just to figure out how can you build credit without actually taking on debt that you might not be able to manage, right? And really fully understand. Because at that point, you're not under the wing anymore of mom and dad, and you might not be telling them that you have this credit card or whatever it is, right? And the ability and to your point, does every kid, or I call them kids, but does every 18 to 24-year-old necessarily already have history for paying bills out of their checking account? Potentially not, but as they begin to enter into like being more called self-sustaining, there's clear ways for them to actually get benefit from the bills that they already are paying that are never being reported, right? So rather than going and getting into debt and taking out products, before you do that, because you're going to get worse rates, you're not going to have credit history, and the people that are going to give you credit are going to it's not going to be at like 12%, right? It's going to be a lot higher. How do you actually flip that and start to make more payments out of your checking account that can then go to the bureaus to establish that credit? And it's the same thing for immigrants that are new to the country with limited history. So I think that this being what we're doing at Bloom Plus, but specifically just checking account transactions, is very interesting for those younger demographics to be able to start understanding their own bills, how they're paying their bills, and getting insights into that. But at the same time, being able to build credit history off of it.
Right.
So that when it is time to start taking out that first card or getting that first product, one, lenders are going to see that you actually have trade lines and stuff that's actually been reported, and hopefully you get the benefit of them saying yes to you, but also yes with better rates than you otherwise would have received. And I think it also really helps the FI, right?
Mhm.
Because if I'm an FI and you look at the average age of, I think, community bank and credit union customers in the United States, so that's like 53 or 54 years old.
Right.
And the median age, I think, of the US demographic is like 39 years old or something like that. They have potentially an existential problem, right? As they need more access to more new young customers to continue to engage with. And if you have a product like this, you can start engaging and get people to actually build credit out of a checking account. It's hard to untangle that, right? Because you have to then go to someplace else to go and use it. And I think that this is a very interesting opportunity for FIs to be able to engage these demographics. Even going back to more demo data, I think that the max peak year from an age perspective for call it the revenue generation for a bank customer is like 46 years old. So once they're over 46, they typically are done with most of their major purchases, a lot of their things around interest, generating interest income off them. So that's the peak year. And if the average age of a member or customer is 53 or 54,
Right.
you have to figure out this problem, right? In terms of attracting this other generation of customer, because how do you then use this as a tool to get them into those mainstream credit products that you're going to make money off of, but also act as a bridge to a lifelong relationship with the consumer?
Right. Yeah, that makes sense. And because for me, like my son has had a teen checking account with one of the major banks for 4 years, so he's going to have history, and he's got income coming in from his little part-time job, and most of the outgoing is just eating fast food and stuff, which he has to pay for himself. But but anyway, I digress. I want to switch gears a little bit. I'm running out of time. I want to talk about you won Best in Show at Finovate Spring in San Francisco. Congratulations. I'm curious now, that was what, 4+ months ago. How has that helped Bloom Credit over the last 4 months?
Yeah, so we actually announced, that was when we first announced the product, and we were fortunate enough to win. I think we got the most votes of all 60 companies that presented, and which was very exciting. And it also, in addition to being exciting, it was very validating because the folks that were voting, that were in the audience, were largely bank and credit union attendees. right? Which I think really kind of was an affirmation that kind of what we're doing here with Bloom Plus is a need and resonating with industry executives. So that was one thing that was great. So we announced it then, and then we launched with our first launch partner, which is a credit union out of the Philadelphia area in late July, early August, and have been moving out of that launch right now. And we have a interesting pipeline of some very large FIs, some that are kind of far along in the process, who have, I say this, shockingly moved very, very quick in the process. And I say that because, I've been working with FIs for a long time, and typically like a sales process can be anywhere between 12 to 18 months, sometimes 2+ years. And some of these folks have actually been moving much, much faster, which I think, again, is indicative of the positive reception to this product and how it can actually benefit FIs as well as their customers. So ultimately, it definitely gave us some visibility on what we're doing, but it also, I think, validated the real need, especially afterwards. I think after I got off stage, even before we won, I think I had like 25 bank and credit union folks lined up to actually talk, to learn more about what we're doing. So that was really good reinforcement, right? That what we're working on is the right stuff.
Right, because as you say, I mean, they are looking for things to attract younger demographics because they know they have to, as you just pointed out. So I can see how they could see this as one of the tools to help make that happen. Okay, so last question. What is your vision for Bloom Credit? Where do you think this is going?
I think it goes back to when I first came on board and kind of what I mentioned earlier. The first thing that I wanted to do was to build a modern platform that met the needs of today's demands of credit data, meaning that like it's not just about looking at someone's traditional FICO score with based upon their loan and their credit card payments and whatnot. There's all sorts of different things that can go into assessing someone for credit risk. And the real opportunity is, how do you make rails and systems that can receive and transform raw data from various different disparate sources and different types of data, take that and transform it into literal pieces, bite-sized pieces that bureaus and others can use. And that was the first thing. How do we do that? And I think that we've done a really good job of doing that, and also establishing ourselves within the industry as a very good partner and good player and collaborator with both clients as well as the bureaus. And I think that over time, my vision for it is that we continue to actually expand to be able to really bring in as much data as humanly possible, or maybe not even humanly if it's AI, possible, to be able to actually go into the system so that everyone benefits, like I said, the lenders, the bureaus, as well as the consumers. And I think that, what I would like to do is to really be like the de facto rails that credit data is transmitted on. Again, to benefit everybody. There's folks out there that I think that potentially could look at this and be like, oh, how is what he just said going to negatively impact me and my business? Our whole point is that we think it benefits the entire ecosystem if as much stuff is out there as possible. And I think everyone benefits when there is a single standard that's actually doing it, with also developing a new standard of care at the same time for the data, as well as making sure it's accurate and in the best interest of all parties, especially the consumers.
All right. Well, we'll have to leave it there, Christian. Really, really interesting to hear the story here. And congratulations on your success this year, and best of luck in the future.
Thank you so much for having me on.
Well, I hope you enjoyed the show. Thank you so much for listening. Please go ahead and give the show a review on the podcast platform of your choice, and go tell your friends and colleagues about it. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye.